Okay, this will be webinar 3B. 3A, it's a continuation from 3A. We were talking about cash method, accrual method of accounting for tax purposes, and we were saying basically that the general rule is whenever you have inventory, you're going to have to be reporting on a accrual method basis, and then there's this exception to that, which is if you're a small business, less than $1 million, everybody can report on cash method even if they have inventory. After that, certain businesses are allowed to report cash basis, but generally between 1 million and 10 million, everybody who's on inventory is going to be at accrual method, and it's only in this range from 1 million to 10 million that it's service type businesses that'll be allowed to be reporting on a cash method. But if you're retail, wholesale, after $1 million, all bets are pretty much off. You're going to be reporting on a accrual method of accounting. And that bears out, by the way, with the tax form itself. You go to page 2 and look what you got there. I know some of you, I was like this until I really got used to it. Some of you are like me, where you cringe when you start seeing the cost of goods sold calculation. Not that you can't do it, but when you're asked questions and you're supposed to answer them quickly, it's like, okay, inventory goes up, goes down, what does that do? And you got to sort of do the little algebraic mathematics to the thing. But if you got inventory, you can see they're going to follow exactly what accrual methods that we're accustomed to figure out cost of goods sold. Here on line 42, after doing all the mathematics, and then they're going to bring that over to line 4 to compute gross profit on line 5. Okay, with that in mind, let's go back to the basic rules here, and let's see what we got. Yeah, there we go. Okay, so in cash method of accounting, we're going to learn a nuance and a particular break that cash method taxpayers get, and then we'll learn something along the lines of what the accrual method is for accounting purposes for the income tax reporting. Okay, so here we go. Cash method, prepaid expenses, like you would expect, may be fully deducted when paid. I'm just reading right along here with me. Unless the payment creates an asset extending substantially beyond the end of the year. Okay, so prepaid expenses may be fully deducted in the year of actual payment unless the payment creates an asset extending substantially beyond the end of the year. Taxpayer is not required to capitalize the payment if the benefit expires on or before the earlier of, and here's where the regulations give us somewhat of an exception to what well, not an exception to what we do for accounting purposes for cash method, but well, actually it is. Let me restate that. This is going to be an exception to the general method of cash basis accounting that we would think. Cash method basis accounting to us, if you pay something, when you pay it, that's when it's expensed, and that's it. End of story. But here there's a limitation, and here's the limitation. You do not have to capitalize like we would do for accrual accounting prepaid expenses if the following is true. And it'll be easier to see this in the example, which is why I've included examples here. So the rule is that a prepaid benefit that doesn't extend beyond 12 months after the first day in which the taxpayer realizes the benefit of the expense or the end of the following tax year. Okay, so let's see how this works. Let's go to Dr. Payne. Dr. Pain in the mouth. That's the first example because he's a dentist. That's why he's a pain in the mouth. On December 1st, 2014, look what he does. He's cash basis method. Why? Because he's under $10 million and he's a service business. Had he been selling widgets, even if he was under $10 million, but over $1 million, he'd be required to do accrual method accounting. Okay, so he's cool. He can report cash basis even if he's over $1 million. Maybe he's not over $1 million. Maybe he's less than $1 million. Then he can do cash method all day long. But at any rate, as a cash method basis of accounting, he pays a $10,000 insurance premium for a 1-year term. It's property insurance. It begins on February 1, 2015. When December 1st, it's a prepaid expense. Notice what he's done. On December 1st, he's prepaid $10,000 of an insurance expense. The expense doesn't begin to accrue, quote unquote, until February 1 the next year. So this benefit attributable to the $10,000 extends beyond the end of the tax year following the tax year in which the payment is made, meaning the benefit of the insurance expense extends into 2016. Why? Because the premium is for 12 months. The 12 months starts February 1, 2015. So the last month of benefit of that $10,000 premium is January 2016. It goes from February 1 to January 31st. So you pay $10,000, so 1/12 of the $10,000 extends into January of 2016. And the 12-month rule now does not apply, meaning the exception allowing him to take this prepaid deduction even as a cash method doesn't apply, and he must capitalize this and amortize it just as if he was an accrual method accounting taxpayer. Only for this item. Only for this item. Everything else remains cash basis. But for this one item, he's got to follow accrual method accounting. This is tax law's way of saying you can be tax method, but don't take undue advantage of it. Let me say that again. This is tax law's way and the regulations' way of saying we're allowing you to be a cash method taxpayer, but don't take undue advantage of it. These laws are not the same when it comes to real cash basis method accounting. So don't confuse this for GAAP in any way. Well, GAAP's not cash method, but GAAP rules for cash method. Okay, so that's example number one. So what he'll have to do, and we finish the example by saying now none of the $10,000 is allowed to be expensed in 2014. It's all capitalized. None is amortized in 2014. And 11/12 of it gets amortized the next year, starting February 1 of 2015 through the end of the year, with the last month being amortized in January of 2016. Take a look at example variation here on this page. And let's see what the variation says. So what the variation says is same facts, except the insurance term begins December 15, 2014. Now the 12-month rule applies. Why? Because what happens is the benefit does not extend more than 12 months beyond December 15th of 2014, the first day the benefit is realized, nor beyond the tax year following the year in which the payment is made. So now he can deduct the whole thing in 2014 and no amortizations required. And that is cool. That's one of the advantages of being on a cash method, because under accrual method you would have had to capitalize it as a prepaid expense, use the amortization method. In either of these cases, it wouldn't matter. So it's this is great. This is really cool. And this will be a good polling question to do the 12-month rule to make sure you understand how the 12-month rule works for cash method accounting taxpayers in a business setting. So you don't want to wind up, and that's, by the way, an interesting nuance. You can say I'm cash method, but hey, guess what? In example one, cash method, you're still going to have to do some accrual method accounting if you violate the 12-month rule. And let's see, the last little bullet there. That's relates to when I give this as a seminar to other accountants, other CPAs. So I don't need to go over that. But I would say one thing here, that when it comes to making the election of which kind of tax method you're going to follow, cash or accrual, if you choose cash, and then later, even if the law still allows you to be a cash taxpayer, then let's do it the opposite way. If you choose cash, and you grow to the point where you're beyond, say, $1 million, and you've got inventory, so you have to go to accrual, you must make the switch at that time. If you're service based and you go beyond 10 million and you're not a personal service corporation qualified under the Internal Revenue Code, then you've got to go accrual method at that time. And the regulations tell you that you do this switch automatically, and you follow the regulations on how to do the switch from a tax standpoint. Okay, that's straightforward. You're just following the law and you're doing what you're supposed to do under the Internal Revenue Code. But let's suppose that you chose cash initially and you're still allowed to report on a cash basis, but you've determined that it would be better to go to an accrual-based system for tax purposes because it would just be better. You'll pay less, maybe you'll recognize less tax. Maybe the accruals will help you. Your situation could have changed, and cash method isn't as lucrative from a tax planning standpoint as it used to be. Could be any number of reasons, and we could try to dream up examples, but it would be thousands of variations we could dream up. You can make this switch from cash, which was your initial election. You can make that switch to accrual, and the tax code and the regulations allow you to make that automatically. In fact, they give you an incentive to do it because in the switch from cash to accrual, you might have some income that you have to recognize in that transition. So the Internal Revenue Code allows you under Section 481 to recognize that accrued income that you have to recognize in the year you make the switch. You can recognize that out over 4 years. You don't have to recognize it all in the year you make the switch to the accrual method of accounting. Let me say that again because this is really cool if you get into a situation where you'd be better off being an accrual-based taxpayer. When you make the election to switch from cash to accrual, the tax code is giving you an incentive and the regulations give you an incentive. One, they say it can be automatic. You don't have to write to the National Office of the Internal Revenue Service in D.C. to get permission. You can just make the change. It's automatic. You have to file a form. But it's an automatic change, and under Section 481, to the extent that you've got income to recognize in the year you make the transition, you can spread that income out over 4 years and defer paying the tax over a 4-year period. And that's a wow. That's great. Now, if you want to go from accrual to cash, and under statute you're allowed to, you made the initial election to be accrual based, but you're under $1 million or you're whatever, you're still allowed to be in the cash method, and you want to go back to that the tax code and the regulation says, hold on, buddy. You got to write to the national office. You got to get permission. This is not an automatic change. So what's going on here? Well, what's going on is, I think you may have already figured it out, but what's going on is that the tax code and the regs and the IRS recognize that accrual method is a pure form of recording income and expenses. They would prefer everybody reports on an accrual method so that the true amount of net income gets reported year by year in the year it belongs. And there's little manipulation that people can do. And so if you want to make the change to the pure, the golden standard of accounting methods for tax purposes, you want to go from cash to accrual. It's like, here's the yellow brick road. Go ahead and do it. We'll give you all kinds of incentives and breaks to do it. You want to go the opposite way, that's when we put up a stop sign. You're going to have to prove to us that you got a good reason for making the change, that the government's not going to get shortchanged. You got to write for permission to do that. So that's what accounting changes are somewhat about. Automatic accounting changes or allowances to allow people to make automatic accounting changes are generally better accounting methods, and so the government allows for these automatic changes without having to stop the whole wheels in motion and write to the IRS in DC. Okay, let's just talk about accrual method accounting for a minute and just see a couple nuances that exist there. Let's see, under the accrual basis, the method of accounting is defined in the tax code as to how do you recognize income when you're an accrual basis method of a taxpayer. And here we've got what's the general terms, and we'll have a couple polling questions out of these terms as we go along to make sure you're following what they mean. There's the all events test. That's number one, all of it, and actually that's A. Letter A represents A1 and A2 is what we call the all events test for income. For an accrual basis, all events have occurred, fixing the right to receive the income, and it can be determined with reasonable accuracy. If you have, let's concentrate on number B, letter B now. If you have a situation where you're going to accrue income because it's been billed, but based upon experience, it's not going to be collected, well, that's basically A2, saying you can't determine with reasonable accuracy that you're going to collect it, and it's not measurable. Is really what A2 means, but A2 could also mean that you don't think you're going to collect it. So letter B is expounding upon this concept of how much are you going to reasonably be able to collect, and if it's none, then you don't have to accrue it. In fact, if you can reasonably make an argument that of the full amount, not all of it will be collected, then you should only have to accrue what will be collected or what is expected to be collected. You can't take advantage of the letter B and do that for everything and just say, oh, I didn't think I would collect any of it, but in reality you do collect 95% of it. You can't do that, but you can, within reason and with experience and the ability to show evidence that there was a high likelihood of not collecting, then you don't have to accrue that. So that's good to know, because every so often bills are sent out at the end of a year and they would have to be accrued under the accrual method of accounting. And for tax purposes, if you can go through there and you pick out ones that are clearly going to be bad debts from experience, then you don't have to accrue those. Now, if you look at letter A, 1 and 2, and if you read it the way I read it, it almost reads like the requirements to accrue income for GAAP. It's not quite as detailed. GAAP's a little bit better in describing it, but I think tax law is trying to follow a GAAP principle here. I think that's the idea. Letter C, advance payments under accrual basis accounting are not income if not yet earned, so you can put advance payments in a deferred income account and recognize that as income when the services are rendered. And letter C shouldn't be surprising. It's there just to mention that the tax code allows for it. One would expect it if you're following accrual method of accounting that's what you would do. So it's there because it was a controversy as to what tax law's interpretation of advance payments. They didn't want people taking advantage of, well, just put that to deferred income and we'll pay the tax on it next year. If it clearly is not yet earned, and that's all it is a customer deposit, then you can follow regular accrual method and just defer it till it's earned. The exception is that if it's an advance payment, but there is no requirement to refund, and the likelihood and experience is that we don't refund, even though the services have not been rendered, then tax law takes the argument that you probably should be recognizing it in income. It's not deferred because you have no further obligation. You don't have to expect that you're going to refund it, and so that's basically the exception. But if there's a likelihood that if you don't finish all the services, some pro rata amount will be returned, that's still an advance payment, and you can put the credit to deferred revenue instead of revenue. It goes on the balance sheet as we should know, and then it gets put back into income as it's earned. Okay, letter D is important because warranty income is generally recognized when it's received. Guarantee payments or warranty payments, and you're probably familiar with these as a consumer. You pay, Radio Shack $20 for headphones, and then you pay them $8 for a 2-year extended warranty. Technically speaking, Radio Shack has to recognize the $8 for the warranty in income the year they receive it, technically speaking. There are some exceptions to this that are creeping into the regulations and the tax courts on the theory that it's not really good accrual method accounting to require warranties to be included in income immediately. And so there's been some and deterioration and some movement allowing for warranties to be deferred. So you'll have to see those exceptions when you get into that in more detail. I don't think it gets into detail in this course, so we'll go to the next step. How about deductions for accrual method accounting? So this is, again, following what's going to be called the all events test. And I'm sure there's some questions I'm going to get out of this. So you take a deduction when all events have occurred, establishing that you have a liability. You can determine that the liability is reasonably accurate. And then there's a sort of a new element here, what's called economic performance, that not only have the events established that you have a liability and how much you're going to have to pay, which I could do. Let's say I could do it this way. I can satisfy 1 and 2. I'll tell you that I'm going to perform accounting services for you next year. You're holding in the month of December. We're almost there. Or we will be there when you're, for some of you listening to it in December, listening to this webinar in December. You're holding with a lot of income. You are in accrual method accounting, and you'd like to add some expenses. So you say to me, or I say to you, hey, I'm going to perform your 2014 tax return. So why don't you accrue my bill? I'll send you the bill now. You agree that you owe me the money. I agree that you owe me the money because I'm billing you now. And you should be able to accrue that because I'm billing you, and the events have occurred establishing that you owe me the money. And that's number one, A1, and the liability can be determined because I have a bill, A2. So along comes economic performance that says, that's nice, but the services have to be rendered. The services have to be rendered. However, tax law then further developed, and that's 3B, where, okay, so if we made a contract that I'm going to do these services and there's no escaping the contract, there's no real outs to it, so you have a liability, that's A1 and 2 have met, then if you meet 3B, which is the 3.5 month rule, then the accrual can be made at the end of the year, even though the services or the property hasn't hit, quote, 3 economic performance. Number 3, economic performance hasn't happened. As long as the economic performance is reasonably expected to occur within 3.5 months after the payment date, then the accrual can be made. So that's the key with number 3B. The 3B is, it's not just the liability, it's not just the billing, it's the payments made. So that's important. That's a good polling question that even I almost forgot. 3B is based on payment. So that's an exception to accrual method accounting where the economic performance hasn't occurred. But if I pay it, even as an accrual method taxpayer, if I can reasonably expect within 3.5 months that the economic performance will occur, which is either the rendering of the services or I get the product, then the accrual the accrual method stands with the payment being deducted. We don't have to what would we do with the expense if we paid it and we haven't received the product yet or a service under GAAP, we would put that to a prepaid expense. So tax law says, well, if it's a prepaid expense, but it's going to happen within 3.5 months that you'd be able to reverse that entry of prepaid expenses, then you can just ignore prepaid expense, take the deduction in the year you pay it. Let me say that again because that's basically what's happening, and I'm saying it in better accounting terms. So your accrual based for tax purposes, you've got what is essentially a prepaid expense, which normally you would capitalize and expense when the service or product is changes hands or the services are rendered in the next year. But here, if that's going to happen within 3.5 months, the regulations say, okay, you can expense it since you paid for it. You don't have to put it in prepaid expenses if it's going to happen that quickly. And that's basically what's going on there. It's a good rule to know. That's why I put it on here, because it's one of the few exceptions to the general overriding principles of accrual method accounting. So it's kind of cool to have that one. So here, take an example. First example, Karina's Crafty Coffee Shop wants to prepay for deliveries a month in advance. So they pay for it in December. The deliveries won't occur in January. Again, the key is they've paid for it for income tax purposes. Oh, I see. The name of the coffee shop is 3C. I'm looking at 3C, and what the heck is 3C? There's only 3A and B up there. All right. Karina's Crafty Coffee Shop. The 3Cs. Okay. So she deducts it, and she actually pays for it in December. Service hasn't been rendered, so you could argue economic performance doesn't occur until January. Nevertheless, that's within 3.5 months of making the payment. So she's good. She can take the deduction, even though she's accrual method. Okay. There you go. That's it. Don't worry about the warning. Well, yeah, you can read the warning, and I wouldn't say that questions wouldn't come up on that. Someone do me a favor and check out the textbook and see if the textbook talks about the 2.5 month rule when it comes to accruing bonuses at the end of the year for employees. And maybe it does. Maybe it's in the chapter on compensation, so we're coming up to it. So it could be that we can hold off on that for the moment. All right, that's cash method, accrual method. That's what I want to say about that. And I'll pick you up at webinar number 4 when we get there.